Now let's look at Blade Score. Similar approach we're going to use. The first thing is let's put our initial outlay here so we don't forget it, and that is 450. Yeah, we'll just keep it there. But let's deal with the P&L items quickly. We know that there's an inflow from this investment every year, that is 220. That's constant. But next thing is tax adjustable depreciation. And in this question, you can see it's slightly different. It's not the usual straight line method or reducing balance. What it told us is that the machine will attract 70% initial allowance, and the balance is to be written off evenly over the remainder of the asset life, and this is allowed against tax. So which means the first year it will be 70% of the asset value, which is 450, and the balance will be 15% each year for the tax allowable depreciation. So this will be for the 2 years, and this is for the first year. Yeah. So I want to stay consistent with the method that we have been using in AFM, because I know in your FM days, you don't do all of this. You just calculate tax on 220, then you add the tax benefit and all of that. You will get slightly different answer. Yeah, but however, I would advise you to stay on this method because this is what you need to know here. And it's a realistic approach. Likewise, is what you've been using so far, and it doesn't lose any mark for you. So please deduct your depreciation before you calculate your tax. Here, is there a loss? No loss on disposal, because at the end of the life of this project, the asset value is 0 and there's no scrap value, no loss, no gain. And after that, we can have a taxable income, which are profit before tax. That is adding this and this guy. So you can see now in year 1, there will not be taxation because there's a loss, which you will see. We can't get tax, so put 0 for year 1. But for year 2, the loss in year 1, we need to recover it, use it. Let's use it up for the next year that made profit before we'll pay tax at 30%. Yeah, but it's going to be negative because it's cash outflow. Please take note. And for year 3, there's also tax that will be paid at 30%. Once we know taxation, we can get our profit after tax. Easy. And that is profit before tax less the tax amount that we're paying. And that gives us the information that we need for profit after tax. But this is not cash flow. What we need is cash flow, which means we need to make adjustments for non-cash flow items. And the first one that comes to mind is tax allowed depreciation. We deducted it before, we need to add it back for each of the years. And once we do that, then we can get our total cash flow, which is equals to, for year 0, that's our initial outlay. For year 1, that is all the adjustment we are making plus the profit after tax, and like that for all the other years. Now we can get our base case NPV, but we don't know the rate we're going to use. At what rate? And that is our first working one. We need to get our cost of equity using CAPM. To get that, the first thing we need to get is our asset beta. Remember the formula we always use, that is volume of equity. So this company used to operate in the food manufacturing, but they are going into plastic business. So we need the asset beta in the plastic business. They told us that the plastic industry has an average equity beta of 1.368, and this is the financial structure. So debt equity of 1 to 5, which means that equals to equity divided by equity again, plus debt, that is 1, multiplied by 1 minus t. And 1 minus t is 1 minus 30%, that is 70%, 0.7. Then all of this, we have to multiply it by the equity beta in order to degear it 1.368. And with that, we would have declared that industry. So the asset beta is 1.2 that we need. Since we know this, we can easily get our cost of equity using CAPM to be risk-free rate. Risk-free rate that they gave us in the question is also still 10%. So we'll put that 10% plus beta that we know now. Beta is 1.2 multiplied by the market premium, and that is market return of 15% minus risk-free of 10%. That is 5%. And that is 16% again. So which means this NPV has to be at 16%. So we can quickly calculate that. So this equals to NPV at 16% for all these cash flows plus the initial outlay. And that gives us 1.97. Still positive. If you had used a different method of doing tax on this first, then bringing tax benefit later and all of that, you get something different but still positive. So the decision will still be the same. Both approach, yeah, fair. But I would say for your advanced FM, please stick to this approach. Make necessary adjustment before you calculate tax. So now we have our base case NPV. We now need to think about our financing effects. Financing effects. And you know the first one is usually to deal with issue cost first. So let's do working 2. Working 2 on issue cost. The same approach I taught you. First of all, in this question, there are 3 types of funding. There's a cheap loan, there is bank loan, and there is equity. What we know is that the cheap loan, which is from the government, they told us that we will not have any issue cost. So let's say initial fund needed. Step this down. Fund needed, which is what you need for the project. The cheap loan from government, 90. The bank loan will also give 90. And the balance will come from equity. And that is talking about 270. That's the balance. You can calculate it, because if you need 450 for the project, and you get 90 from government, 90 from bank, you need 270 left. So that's fund needed. But how much do we need to raise? Funds raised. Same approach I taught you. The good thing is for cheap loan, the issue cost is 0. So that remains 90 divided by 100%. That's divided by 1. But for bank loan, there's issue cost. And they told us that the issue cost will be at 2%. They mentioned it somewhere here. The issue cost information is here. For bank loan is at 2%, so which means we need to raise 90 divided by 0.98 so that we can take care of that issue cost. And for equity, 5%, so that will be divided by 0.95. So this is what we need to raise if we're ever going to be able to pay our issue cost and are still going to have this amount left. So issue cost is just 0 for the first one. For this one is this multiplied by 2%. See, I'm using another approach so you can be comfortable with that way. I always tell you get the same answer, 5% of what you raise. Remember, issue cost is always based on the total amount you have raised in the market. Yeah. Which is the same thing as doing this minus this, this minus this. It's going to give you the same thing. So these are the issue cost for these loans. And please always remember to do the tax benefit for them as well. For the first one, no issue cost, so that is 0. Second one, there is a tax benefit, 0.3. multiply by the issue cost. And for equity, there's no tax benefits. So it has to be 0. So we have our issue cost dealt with. So let's just call this separately. So issue cost is dealt with. The tax benefit on issue cost also dealt with. Now, let's look at the interest working free. The tax benefit on interest. So tax benefits on interest. So which means we need to calculate our interest. When we know our interest every year, then we'll be able to know the tax benefits that we are getting from it. And like I've mentioned to you in this question, it is not a constant interest payment. Rather, it's a constant 3 equal annual repayment. That's how the bank loan is going to be paid. So which means there is annuity payment. So the first thing you always have to do first is to calculate your annuity cash flow. And I've always told you, your annuity cash flow is equals to your PV of annuity, which is the loan that we are talking about here. Yeah. And in this case, that loan is your total debt that you have raised. And that is this guy divided by annuity factor. Annuity factor at 10%, 3 years is 2.487. So you know that will be your repayment every year. So once you know your repayment every year, then you can quickly do your amortization schedule. Yeah, we have period year 1, year 2, and year 3. So we have the opening, we have the interest payment, we have the repayment, and we have the closing. That's our amortization schedule. Quickly, we can do that. So opening is the fund that we have collected. Interest will be at 10% for sure, always. That's what we're going to be using as a cash flow. Remember, that's the bank loan that we're talking about for now. There are 2 types of loans. So the first one I'm dealing with is the bank loan. Just take note. Because the bank loan that will be paid in 3 equal annual installments. You will see the one for government is straightforward because the constant interest that will be paid, since the full 90,000 will be repayable after the 3 years. So the government bond will be easy. So let's do for bank loan. So repayment is constant, is this, and closing is the addition of everything. Year 2 opens with the closing of year 1. Just like that. Repayment is constant. And closing. You can see at the end, you're done paying the loan. So which means we can get a tax benefit on interest now every year for this loan. I advise you to also try and solve this question on your own, even after watching me doing it. Try and do it afresh by yourself. So this equals to 0.3 times the interest that you've paid every year. That's your tax benefit. So every year we're going to have that tax benefit because we have taken loan from the bank. So what about the government? Are there interest? Yes, there's interest, but the interest is the same. So that is easy. So annual interest is fixed since the principal is not reducing. So annual interest for government loan is just equals to the government loan rate, which is 3%, multiplied by the 90K that we collected. So every year for government loan is 2.7. So which means if the interest is 2.7 every year, we're going to get tax benefit every year that is equals to the interest multiplied by 0.3. So that is the annual tax benefit. So which means year 1, 0.81, year 2, 0.81, year 3, 0.81. So we need to get the present value of that benefit. And that is using annuity, the same 10%. Please take note, all your annuity factor is at the cost of debt. Don't make a mistake of using 3% as the annuity factor. Remember, 3% is only for cash flow. You are always using discounting at effective interest rate, market rate. So you stick to your 10%, 3 years, that's 2.487, multiplied by the annuity cash flow, which has that benefit. So that is what you will get as present value of tax benefit from government loan. So we have the tax benefit on all the interest now. For this one, we need to do the NPV as well for each of these cash flows. So let's do we need to get a discount factor quickly. Or we can just even use Excel formula to make it faster. You can use Excel, you can use your manual way, you get the same figure. So I can do NPV at 10%, all of this. So that's the present value of the annual interest from the bank loan. And for the government loan, this is the PV of that benefit. So we have that, we have this. The only thing left for us to do now is to work on the cheap loan. So let's value the cheap loan working for. That's a cheap loan, NPV of cheap loan. Because we have a cheap loan that has been given. So how do you value it? You need to get the benefit. So what's the benefit of a cheap loan? Is the reduced interest rate that you are getting. So you're going to have interest savings. Because instead of paying interest at 10% that the bank is giving, government says you will pay interest at 3%. And government, they do this a lot. They subsidize to encourage businesses, either small or a particular industry. So it's a very popular question you can actually find in an exams. So interest savings is equals to, instead of paying at 10%, you are paying at 3%. So you are saving 7% for the loan that government has given you, and that is 90. So which means you are saving interest of 6.3 every year, annually. That's the benefit that you are getting annually. So if you get that benefit annually, you will also pay tax on it. So it's not free. So you're going to pay tax on it at 30%. So which means you have net benefit, because you have to be net of tax. So your net benefit is equals to this minus this. So that is your net benefit. If this is your net benefit every year, so let's make it clear. Net benefit every year. So you know that the PV has to be at annuity. So the same approach we've been using, which is, if this is annual annuity figure, you need to multiply by the annuity factor. 10%, 3 years. And it means that the total NPV for that loan is valued at 10.96. All our components have been done. There is nothing left. So we can easily just calculate our APV now. So let's do APV. So the first thing in our APV is the base NPV, remember. The more you solve questions, the easier this will come to you naturally. So base NPV, we pick it up, that's this one. Then issue cost, remember, for equity, for debts. So for equity, we got it somewhere here. This guy. But it's going to be negative because it will reduce our NPV. The cost will reduce our NPV. Likewise, for debts, because government bond does not have, so let's say bank debt. Because for government, it is 0. Then tax benefit on issue cost. We also did that somewhere, but we can just multiply it here as well. The same figure, 0.55. But this is a benefit, so that would be positive, which is the 0.55 that we did here. Okay. Once you know the tax benefit on issue cost, let me spell it out so that you don't make benefit. It's a benefit. Please take notes. The next one is the tax benefit on all the loans. And we have two loans. So tax benefit on government loan and tax benefit on bank loan. We have already computed all of that. So just to link it. So from government, I think that is somewhere. There's it. Government bond 2.01. And for the bank, the total tax benefit is 4.85. We have that as well. Then the last one is the valuation of the chip loan. So PV of chip loan, which we also did here. So all our components are there. Then since we have that, we can calculate our APV, which is just the addition of all the components. And that is our APV at 4.3. So it's as simple as that. You can go through it again. Please, like I always say, take time, try and work it from the beginning by yourself. Check how much you can remember. That's how to actually solidify your understanding, right?